All right. Good morning, good afternoon, everybody. Thank you for attending our webinar on renovation ROI, cost segregation to boost your bottom line. Looking forward to a good session today. I think everybody should be muted. So, if you have any questions, feel free to use the chat. You've got some options up in the top right of your screen there for chat, messages, Q&A. Feel free to use any of them. We'll check them all. So again, we're going to talk about renovation ROI, really specifically going through cost segregation. This will be available as a recording later, so if you ever need them later, please let us know. And with that, we will get started. Okay, so we'll go through a little bit of introduction about Leyton, who we are and what we do, and then we'll introduce both of our speakers here. So I'm Mark Bacon. I'll tell you a little bit about myself in a minute, but first, Leyton. We are an international tax consultant firm. We have over 50,000 clients, 3,000 employees, been in business for over 25 years, really focusing in on that interaction of taxes and efficiency, or generally building incentives, specifically for our commercial real estate service line, which is what we're going to talk to you about today. So the way I like to explain it is tax code is really, really broad. You can't expect a CPA to know everything. So you go to companies like Leyton, who can go deep on very specific topics to help you out. So that's what we're going to do a little bit of today with specifically renovations and cost seg. Okay, so as I said, introduce myself. My name is Mark Bacon. I'm the practice lead for our energy efficiency service line, really focused in on commercial real estate incentives. Now, cost segregation is not really an energy efficiency thing, so really we also call our service line commercial real estate incentives. So I've been doing this for almost 10 years now, really focusing, and we've done about 10,000 of these studies on buildings. Just to give you a frame of reference, we get a team of 21 people. Professional engineer by training, really focused in on the building sector. And with that, I think I'll hand it over to Will, who will be doing most of the talking today.
Hi, everyone. My name is Will Wightman. Like Mark said, I work on the cost segregation team on our commercial real estate team here at Leyton, and I'm our senior cost segregation consultant, lead engineer. I lead the effort on the engineering side to complete our cost segregation studies. And I, too, have worked with hundreds of clients to help reallocate hundreds of millions of dollars and help our clients save millions of dollars in taxes, which is what it's all about with these tax incentives. So happy to be here and to share a little more about how cost segregation can help you and your business.
All right, thanks, Will. All right, so today, just to give you an idea of what we're going to go through. So we're going to talk a little bit, we're going to start with the basics and then get into a little bit more advanced, but at a high level, what is depreciation? Why does it matter? So those of you hopefully will understand time value of money. Anybody out there in our audience who are CPAs, hopefully you have a pretty good idea what cost segregation is. And then how do you leverage cost segregation? Then specifically, how do you leverage it for renovations and remodels, which is in itself a very interesting topic. Then QIP, which is also very important. And then finally, how we partner with CPAs. So as I mentioned before, tax code is really broad. Leyton allows us to go deep on certain topics, but I never want to step on my CPA's toes. They're experts in what they do. We're experts in what we do. So we want to make sure we understand what that relationship look like. And then questions. Now, we do have questions listed at the end, but please ask them throughout. We do a lot of these webinars. I do find they're much more interesting if we pivot and handle questions as we go. We are talking about taxes, so it sometimes gets a little dry. So ask the questions when you get them. We've also got polling questions to try to break it up a little bit. Will be doing most of the information, but I will be monitoring the chat to ask questions as we go. So with that, our first polling question should be popping up. And everybody should see a little tab up on the top right there for a polling question. Give everyone about 20 seconds to answer that. Basic idea is it gives us a frame of reference for who we're working with, who is in the audience today, and then how we can potentially leverage a question. So I do find these are a lot better if we tailor our questions, more specifically to our audience. So please ask questions, please answer the polling questions, and we can help you out with that. Okay, Will, I think you are up to tell us what is depreciation.
Awesome, thank you, Mark. So like Mark said, I kind of want to hit on the main reason we're here today, and that is the time value of money. What that is, if you're not familiar with it, is just a financial concept saying a dollar today is worth $1 more tomorrow. That we would, any dollar invested today is going to give you a much better ROI than something, 20, 30 years down the road. So this applies especially to real estate with an asset that depreciates over 30, 40 years. Getting as much of that benefit today is going to make a big difference in how you are able to grow your business or grow your real estate portfolio. So in order to do that, we have these tax incentives, we have cost segregation, depreciation, and that's what we're going to talk about today. And before I jump into cost segregation itself, I wanted to just go over the basics of how it works and the main tool that goes with it, which is depreciation. So what is depreciation? Well, every asset, it degrades over time or it wears out, and this is referred to as depreciation. And because of that, each asset has its own class life. Certain things are expected to last longer than others. Just looking at a building here in these pictures on this slide, you can see, a house, for example, has a foundation, concrete foundation, that's expected to last the life of that asset, 50 years or so, even more, 50 to 100 years. Whereas the carpet in your living room in your house is not expected to last that long. Something like that may be replaced every 5, 7, 10 years instead. So depreciation, you get a deduction for those depreciation amounts based on the class life and asset class that it sits in. So talking about that building, kind of what this looks like as far as class lives, if you had a building that you purchased for $1 million, for a commercial building, its class life would be 39 years. So when it comes to depreciation, you're able to take a deduction of 1 million divided by 39. So a fixed amount over each year of that asset's class life. So in this case, for $1 million, that would be 25,000. Another example that may be more familiar to everybody is a vehicle. So cars obviously aren't expected to last as long as a building. So, it has a class life of 5 years. So if you purchased a vehicle for $30,000, you divide that by 5, you'd get a depreciation deduction of 6,000. And I think we're familiar with vehicles; those tend to depreciate. They lose their value pretty quick. It makes sense to have those depreciation deductions, whereas buildings, even though they're appreciating in value a lot of the time with the market that we have, on paper, you're still able to take that depreciation deduction as that asset gets older and wears out, like we talked about. So those buildings, we're talking about commercial real estate for the most part, sit in the longest lived asset class in the tax code, 39 years. I do want to point out for residential properties that is a little lower, it's 27.5, but for the sake of simplicity, I'll just refer to the 39-year asset class because they function pretty much the same, one's just a little shorter. So as I mentioned before, that isn't the most correct way to do things because you're depreciating the entire building over 39 years when it has assets inside of it that are wearing out or needing replaced on a much shorter class life, 5, 7, 15 years instead. Like I mentioned, the foundation, that's expected to last 39 years, whereas the carpet inside your house, it's not expected to last that long. So how do we approach that? How do we make this more correct and depreciate assets on their correct timeline and put them into the right buckets, the right asset classes and tax lives? Well, that's where cost segregation comes in. As the name says, we are able to segregate out those costs into their correct asset classes. And that's the next thing that we're going to be talking about.
Okay, I think we are up for another polling question at this point. So have you ever considered cost segregation before? Why or why not? You can answer in the chat box. There's a poll in there just to get a kind of a frame of reference for people. Cost segregation is generally a fairly well-known entity, so we do find a lot of people do it. We actually use it as a barometer. It's so well-known that it's a barometer for a lot of other tax incentives to say, hey, have you done cost segregation is the main question for me on whether or not you can layer on top other incentives like a 179D tax deduction for an energy efficient commercial building or a 45L tax credit for an energy efficient home. So cost segregation, really the big brother. I see a lot of people have done. Some people are definitely seeing it for the first time, and really looking forward to getting your thoughts on this later. But hugely valuable tax planning incentive. All right, Will, back to you.
Thank you, Mark. So going over, like we did depreciation, I want to kind of just cover what cost segregation is at a high level. There's a lot that goes into these tax incentives. That's not the point of this webinar. As a client, that's up to us to know the details, the intricacies of things. Whereas, as long as you understand how it works, you can apply it to your business model. So what's the point of cost segregation? We hit it on the head at the beginning, and I want to emphasize it again. It's the time value of money. It's getting your dollars back today to reinvest into your business, into your real estate portfolio, so you can get a greater ROI over the long term. So how does that happen? It comes through tax savings today, which improves your cash flow by not having to pay those taxes, which then enhances the ROI. So that's kind of the how or the what we're doing with cost segregation. And when it comes to the how, or the detailed process, that we're doing here is that it's an IRS approved method of segregating out these different or shorter assets from your building. So it's something that's been around for a while. There's certain ways to do things that the IRS has approved, and that's how we follow it. And we do this by using engineering-based methods, and this is the most correct method or way to do it. And basically, we're able to reverse engineer buildings to appropriately assign a cost to each part of a building, whether it be the foundation, roof, walls, windows, doors, correctly assigning a cost to those and then segregating them out into their correct asset classes is exactly what the name says. We're cost segregating out different parts of that building. So when we split those out, you're able to depreciate those shorter tax lives of 5, 7, 15 instead of the standard 39, and able to take advantage of that benefit sooner rather than later. And then I do want to hit on bonus depreciation. This is a big topic we could talk on just by itself, but it is a fixed percentage that's fluctuated based on year, which allows you to do exactly what the name says as well. And it's just a bonus. So this year it's 40. And what that means is if you're able to segregate out, $100,000 from your $1 million property, you're able to take 40% of that the very first year. So $40,000. So it's an even, it's an additional supercharged benefit for your cost segregation. Instead of just separating out the 5, 7, 15 years, you're also able to take a percentage of all those that you separated the very first year, allowing you to get an even better ROI immediately.
And Will, are we going to get 100% bonus back? Is that coming back?
That's a good question, Mark. I'm not going to answer that. I like to say I hope so. The new administration, that's something that they want to bring back. But as of right now, we have to just go off of what we have. That's 40% for right now. If it does go into place, they're saying it'd be retroactive for anything for 2025. But for now, we have to go with what it is, which is 40%. And then fingers crossed that we get back to 100. So looking at kind of these, I've mentioned a few times, the shorter tax lives, the asset classes, the 5, 7, 15 years are some of the most common. What does that look like? Well, doing kind of a simple cost segregation here, you've got 3 different buckets that we will deal with. So the first one is, where we started, the 39-year class life of your building. Certain parts of the building can't leave that class life. So certain parts of these, I guess a good way to think about it is like the structure of the building, certain parts of the shell. So like the walls, windows, the foundation. We can't touch any of those. We can't move those out of the 39. The second one is the land improvements. This is a 15-year class life. Anything to do to improve the land around your building, we can reclassify as a 15-year asset. So parking lots, curbing, storm drainage, sidewalks, any kind of landscaping, we're able to reclass to 15 years. And then the last one are other parts of the building that should be depreciated on shorter tax lives, like 5 and 7 year. A big one that I pointed out here was like carpet, certain kinds of removable flooring, furniture, fixtures, equipment that serve your business can be reclassified into 5 or 7 years, which is, you know, an even better benefit than the 15. So going back to our example of $1 million building, if we're just depreciating that over a straight line, 39 years, you're getting a $25,000 deduction or so every year. What would that look like with cost segregation? With cost segregation, if we're able to split out or segregate out 200,000 into land improvements or 15-year property and another 100,000 into 5-year property, you know, that's 300,000 that we're able to accelerate, and adding that into the lower fixed amount from the 39-year gives you a new depreciation amount of $317,949. And assuming, you know, this building was purchased in 2021, then bonus depreciation went 100% that year. So you'd be able to take that full amount as a deduction first year to offset your income, taxable income. Okay. So now that we've kind of covered, you know, what cost segregation is, how it uses depreciation, we've mostly just been looking at, you know, purchasing or constructing a building. I want to talk on a third piece that maybe a lot of people don't think about, and that's doing a cost segregation study for remodels or renovations.
All right, and that brings us up to our third polling question. So have you done renovations in the last 10 years? Or are you planning on renovating a building that you've had for the last 10 years? Now, the poll should be opening up for everybody. The reason why we asked that question is, like Will's been talking about, straight line depreciation. If you go back too far, you've already straight line depreciated a lot of the asset. So it's really important to see how long have you held the building. So we will be upfront with you when we do studies for you to tell you, hey, you've already accelerated 2/3 of your depreciation. It may not be worth doing a cost seg study. It's important to do the math on that one. So that's really why we asked this question. Okay, and we're seeing results come in. Thanks, everybody.
Awesome. Thank you, Mark. Yep, and exactly like Mark said, you know, every situation is different. Always happy to look at your particular situation to see if any of this would ever be worth it. So along those lines, I want to point out again that there are 3 main triggers to get a cost segregation study done. You purchase a building, you construct a building, or you complete a major remodel or renovation. So acquisitions, new constructions, they operate mostly the same based on how we talked about cost segregation before through that example. But with renovations, there is an additional element that I want to talk about today that makes the benefit even more lucrative. And this is called qualified improvement property, or commonly known as QIP. So what is QIP? So it's pretty complicated. You know, we're not going to dive into very many details here, but I do want to point out a couple definitions from the IRS of how it operates. So it's, you know, it's another class life or asset class, kind of like we talked about with those land improvements and personal property at the 5, 7, and 15 year. But it's defined by the IRS as an improvement made to the interior of a non-residential building after the building is placed in service. So there are certain exclusions here, like elevators, any structural work, and I do want to point out any additions to a building are also excluded. So it's just renovating the interior of an existing building. And this is known by a lot of different names in the real estate world: renovations, remodels, leasehold improvements, tenant improvements. Basically, whatever you paid for, you're able to take advantage of on your taxes. So what makes it different? Well, you know, typically on a regular study, we're segregating out into 5, 7, 15 year class lives from the original 39. And we can't touch a lot of those parts that I pointed out that are not structural, part of the, the shell of the building on the inside. So examples of that would be like interior walls, the interior doors, paint, any kind of bathroom accessories or interior HVAC, plumbing that is usually left in that 39-year class life can be reclassed into 15 years as QIP. So as you can see, when you're adding that in with the other ones from the original building, from the original acquisition or new construction, that's really going to increase the amount that you're able to reallocate and increase your deduction amount. So just a quick example, if you were to purchase a building in 2019, you could do a cost segregation on that. And then if you did a major remodel a few years later, let's say in 2022, for an updated office space or for a new tenant, you're able to do a cost segregation again on that remodel, but you'll have that accelerated boost for any of that interior work done being reclassed into 15 years. So this can look a lot of different ways based on when you do the remodel, but basically, the rules say the building needs to have been placed into service by someone before you can take advantage of QIP. So you can't just build a new building and then finish the inside and take that all as QIP. It needs to have been placed in service previously. So real quick to show how this would work in the real world, here's a case study that we had. This was a restaurant. It was fully functional. New client came and bought it. And the top picture with the blue window coverings is how it was originally. Did a cost segregation on this purchase and was able to segregate about 30% of the $2 million purchase price. But because of the new franchise they were working with, the new restaurant, they needed to remodel the interior to meet the needs there. And most of that renovation on the interior qualified as QIP or personal property, the 5-7 year. And we were able to segregate out 90% of that $1 million renovation. So almost the entire thing. And when you think about the ROI, especially with bonus depreciation, investing $1 million and then getting 90% of that back as a deduction, you're getting a really big piece of your initial investment back first year to, invest into a new building or into your business again. And it just really accelerates that ROI and gets that money back to you today. So talking through the 3 different ways, again, the 3 triggers for cost segregation is an acquisition, you construct a new building, or if you complete a renovation on those buildings. And because of QIP, we're able to supercharge that benefit and make it even more lucrative to everyone that completes those renovations. And it's a great way to get your money back sooner, rather than later because of the time value of money and the tax savings that comes with it.
Okay, thanks for that, Will. Back over to me for a little bit. So the biggest question we tend to get with cost segregation is, why doesn't my CPA do this? Now, a lot of CPAs do. If you have heard of it, hopefully you're working with a CPA who's pretty familiar with it. Not all CPAs have the ability to do that. So what Leyton is able to do is we can work with your CPA to really drive the value prop through. And if you go to the next slide, Will, I can just give you an example of how we do that. So there's a few things we're going to look for, and I'll go through this, so we can answer some questions as we go through this short and sweet 30-minute webinar. We got about 5 minutes left, but I'll go through this and then answer questions that are coming up through the chat right now. But we partner with CPAs by looking at a few things. So as we mentioned before, cost segregation, the length of ownership really matters. So when did you accelerate depreciation? You can look back on these later to say, okay, we were owed accelerated depreciation, but we didn't do it. So we work with the CPA to figure out, look, do you need to file a 3115? We also go and work with them on interaction of other credits and deductions. And I mentioned at the start of the webinar, if you're building a commercial building, you may be eligible for a 179D tax deduction as well. The analogy that I like to use is cost segregation is the cake and 179D is the icing on top of it. So it's not as, valuable. If you look at a picture of a cake, it's not as large, the icing, but it's certainly nice to have. So you can layer these on, and we can work with your CPAs to help do that. And then really figure out what the value add. The other big thing is tax position. So when you want to do a cost segregation study, you need to really understand the tax position of all of the owners of that building. And we work with CPAs to help sort that out. What we certainly don't want to do is go all the way through doing a study and then find out later, oh, wait, they can't use tax deductions. So we work with the CPAs to make sure that is possible. And then the type of information that we would gather, a lot of it is information you'll see if you look at this list that the CPA does have or should have. So details around depreciation history, any other credits or deductions, like interactions with other credits definitely comes into play. Then we go to the owner. They're usually going to have information around construction invoices. As Will mentioned before, this is cost segregation, the key there being cost. So it's very important that we're able to gather all of that. And that can run the gamut of really detailed information all the way to coffee stained invoices. I will say, please don't send us too many coffee stained invoices. Will have a heart attack. But the better cost information we have, the better result you're going to get. And again, it goes down to the architectural documentation. So what you get out of it is basically a narrative report that will have your new depreciation schedules. That's what goes to the CPA to put that on your tax return. So basically at that point, you've reclassified things, you know how much depreciation you've accelerated, and you've got all of the backup around the documentation. And then we work with the CPA on guidance around filing. So we provide audit support, in the unforeseen audit scenario, we're able to help out on that. And then any ongoing consultation. So like Will mentioned before, if you come in and QIP something after we've done a cost seg study, we'll help you out with that as well. So really, there's a lot of ways to interact. As I mentioned before, one of the key things for us is we don't want to step on the CPA's toes. They have a lot of the information. If they can do the cost segregation study for you, great. If they can't, we are happy to help. But it is important that the CPA be engaged in this whole process. So with that, the last slide is questions. And I see a couple have come in from the chat. So I'll just go through and answer. Will, this is probably going to be an easy one for you, but there is one in there about basically recapture. So what if we dispose of an asset? Neil was asking, if we dispose in 2 to 3 years, what do we do? So that is a recapture question. Will, I'll hand that over to you.
Yeah, great question. So recapture it can be complicated as well. We're happy to help look at your particular situation. But basically, we do recommend you hold your property. If you're going to do a cost segregation, we recommend holding at least 3, preferably closer to 5 years, because you're able to take most of that benefit from that personal property before selling, because you would have to pay back those taxes that you saved on if you sell too soon.
Yeah, so great question, Neil. One of the most common ones about the tax position we get is if you're not in a buy and hold strategy, then you have to really think, does cost segregation make sense for you? It often does, but it's worth considering. And I know, Will, we've only got about a minute and a half left. So we already kind of answered one of the questions around, can you combine cost segregation with other studies? Yes, you can. And I would really recommend it. Quickly, I can answer the other one. How often should you do cost seg studies? It goes in line with what we just said. You do a cost seg study when you build it and when you renovate it, basically. So you've got options there. I think the other question for you, Will, in our 1 minute we have left, question from Chris. Can we include soft costs like architectural engineering costs, submittal costs, any other costs?
Yes, and we most definitely want those. If it was a new construction, we want that general contractor pay application showing all the hard costs. We want all your engineering and architectural costs as well, because those will both be combined to complete or to find that final basis number, which would only increase, your deduction amount. So yes, those are included.
Perfect. Okay, with that, I don't think we have time for any other questions, but I would say in the 24 seconds we have left, if you have any other questions, there is a link in there to set up a meeting. You can sit down with Will, go through any other conversations. If you do have any questions, please reach out to us. This will be recorded, so you'll be able to look at the slide deck later. And then if you have any other questions, please let us know. And I hope you found this informative. All right, thank you, everyone.